Good afternoon, everyone. Thank you for joining today's webinar. As always, we'll give it a couple of minutes so that people can get settled in, and if they're having any technical difficulties, if they can get over those and join us. But thank you for those who are here already, and we'll get started in a couple of minutes. All right, Neal, it is 12:02, so I think that's a great time to get started. So again, thank you to everyone who's here and joining us for their lunch hour if you're on the East Coast to talk about some tax strategies. The title of today's discussion is 2026 Tax Profitability and Exit Strategies for Business Founders and Owners. And it's featuring Neal Inscoe of Equiti LLC. Before we get started, a couple of housekeeping issues. First, as always, is our disclosure. This webinar is going to be for educational purposes only. This is by no means, this is not advice. So please consult the necessary professionals before making any investment decisions or any tax decisions or tax planning for that matter. Another housekeeping item is going to be about questions and the answers that we provide. So our chat will be turned off today, as always, but please find the Q&A. It should be on the bottom of your Zoom screen and ask questions there. I'll be looking at it throughout the webinar and sharing those with Neal as they come in. And then if as an aside, if you are interested to learn more about self-direction or have any questions about Camaplan, or you have any questions for Neal that don't get asked and you want to ask them later on, you can always reach out to us at engage@camaplan.com or use our phone number. So without further ado, we'll get started. I'm going to stop sharing my screen. Today's format will be a little bit different than what we do on our regular Thursday webinars. Instead of Neal showing slides, we're actually going to make it a little bit more of an interview style presentation. So I have some questions prepared, and I'll let Neal talk about himself and share his background, but really want to encourage the conversational aspect of today's presentation to all of our attendees. So that's my way of saying, please don't be shy, ask your questions, and let's have a nice discussion. So with that, Neal, I'll turn it over to you to take it away.
Well, thanks, Matt. I appreciate being here and thank Camaplan for allowing me to share this time with your business owners and individuals. So my name is Neal Inscoe. I've been in the financial planning, family office space for 37 years. 30 years, I own my own financial planning firm where we did everything, asset protection, tax planning, estate, investment planning. I mean, you name it, we did it. And I started out wanting to work with business owners. There's a lot of advisors back then didn't want to work with business owners, and the reason is because business owners are different people. You know, they take some time to be able to figure out what they want to do with their money and with their business, and they need answers now. You know, a business owner, and I've owned several businesses and sold them, so I can tell you that every day is unbelievably joy, and it's also amazing panic at times. So the idea is that as a business owner, you have special needs. You can't wait 2 weeks to get a CPA or an attorney or somebody to call you back and say, hey, here's an answer to the question. You need somebody to be able to help you with it right away. So I was fortunate enough to go down that path. And over the years, I've had some great relationships with business owners. 7 years ago, I decided that I wanted to run family offices. So I took the top 23 clients of very high net worth, and we structured family offices for them. We did it basically because we wanted to be able to have even more involvement in every aspect of their life. So Equiti is a company now that deals with family offices and works with family offices. I also speak at family office conferences and also give continuing education on a variety of different products and services that work for business owners. In addition, I have two other businesses. One is where there's a CPA and I work with individual business owners who want to transition their businesses. So 65% of all business owners say they're going to transition their businesses, but only about 10% actually do it. They say these business owners, 65% of them say that it's going to be a big part of their retirement. Yet again, only about 10% actually sell the businesses. They do it for a lot of different reasons. They happen because you can't come together, you can't find a sale. I mean, there's just multiple reasons. But the key is, as business owners, you have this major asset. What is it that you're going to do with it? So the CP and I work together to put together what we call a lifetime income and estate projection to show a business owner soup to nuts, tip to tail, how to look at the tax ramifications of it, how it is that they're going to actually take care of the financial implications of it, and then be able to find the right attorneys to be able to help us with the merger and acquisition. That's really critical in my belief, because I think that we need to know today what it's going to look like, all of those aspects versus what's going to happen in the future, right? If we know today, then we can do the proper planning that we need to do. So it's really fun. And we've been fortunate enough to reduce, eliminate, or defer over 42 sales over the last 7 years, about $121 million of taxes. So there are legal, ethical, IRS ways of being able to be able to sell your business and put more money in your pocket.
I'd actually kind of like to just jump in right there on that last part of your intro. If sorry, hopefully I didn't cut you off. Was that
No,
okay? Okay, yeah.
that's good. Thank you.
So you said I think the percentages were 60 or 65% of business owners say they want to transition, which is they want to exit their company, but only 10% do it. So is are taxes kind of the main reason? Is the tax liability the main reason that most don't do it, or are there other reasons?
Well, there are other reasons, but if you had to list them, I would say that that was the number one reason. Because when you look at a business sale of, say, I don't know, $10 million, and if you live in a state like New York or California, you're in a position where the top tax rate are the two highest in the country. So I believe California now is 14.2. It was at 13.4. So it's gone up. And then you add the federal on top of that, capital gains 20% or 23, depending. And now you're looking at somewhere in the neighborhood of every million, you're giving up $370,000. So if you've got this business that you think has this value, and maybe it's been valued, now you're in a position where now it's worth a lot less. It's just same as your 401k. Everybody says, oh,
Sure.
I've got $2 million in my 401k. Great. Well, you really don't, because when you start to take it out, now you're taxed at whatever the federal and state rates are. So yes, taxes are a big part of it. And if we can mitigate those taxes, then it's more money in your pocket and more opportunity to live the lifestyle you want once you sell the business.
Thanks. So I'll start off with kind of just from the top. A lot of business owners hear about tax planning, but are concerned about the IRS. My dad owns his own physical therapy practice, and that was one of his big concerns when he opened it 40 years ago. What questions should they ask their CPA or any tax planner to make sure they're getting the best advice?
Well, CPAs are interesting, right? The joke is that why can't a CPA be an actuary? He doesn't have the personality, right? So, and I tease all my CPA clients about that. Part of the family office process is to teach CPAs to be the firm of the future. So about 67% of all individuals look to their CPA for some kind of advice. The problem is that CPAs are really busy. I mean, when I meet CPAs and I ask them, the first question I ask them is, when was the last time you were home for Easter dinner? Right? They're just not because they're tied up. So I inevitably 9 out of 10 times that people come to me and say, well, I went to my CPA and I asked them about, say, code section, 179 or some code section that maybe he doesn't know about. And he'll say, I'll get to that. And then they just don't have the time to get to it because they're just too busy. They're not proactive and they're not what I call the firm of the future. So you need a firm of the future who can do tax planning with you, and the tax planning that you'd be doing during the year. So you have a meeting with them sometime, maybe after April 15th through about October, where you're actually doing tax planning. Then you're revisiting that plan sometime October, November, maybe December to see if things have changed so you don't overshoot the runway. I'll bet 50% of the listeners on this podcast or would probably tell you that they've had the CPA call them probably April 12th, 13th, or 14th, or sometime between April 1st and 15th to say, oh, by the way, you owe another $50,000 in taxes. That's the surprise we don't want to have happen. We want to know ahead of time by doing pre-planning the year in which the taxes are going to be due the next year so that we're in a position where there aren't any surprises. So that's the number one thing. You've got to go to a CPA that's going to do tax planning, do tax strategies with you, not just do the returns. Because most CPAs are supposed to do compliance work, which is the return, right? And also to do financial statements. But other than that, they really don't do a whole lot of planning.
So if I'm looking at if I'm a business owner and I'm starting to, I guess, interview a tax professional or someone, and I want to make sure they're a good fit, I think it sounds to me like one of the indicators I'd be looking for is sort of them proactively creating a plan for us to meet at least twice over the year rather than maybe taking a more responsive approach, call us when you need us kind of thing.
I think so. I think they have to be proactive. And if they're not, and they're at least knowledgeable, then you have to do one of two things. Either you have to tell them, look, I need to get together with you and I need to have a conversation about my taxes and I want to do some tax planning. Typically, I'll ask CPAs when I meet them, if I'm trying to help them be the firm of the future, I'll say to them, look, tell me the things that you recommend to your clients. Well, most of them say, yeah, I recommend to save taxes. So most of them will say, well, a retirement plan, so a 401k or profit sharing or defined benefit really doesn't move the needle a lot. Or we're going to take every possible deduction we can. Great. Okay, that works, but most CPAs do that. But are they talking about potential oil and gas? Are they talking about being able to reduce your income through W-2 wages so that you get the right tax credit? I mean, there's so many other things that they can do that they need to be proactive about. And that's important. So you've got to be asking them, tell me the things. If you're interviewing them or the current client or the current CPA, you want to say to them, what are the things that we can be doing to reduce or eliminate taxes? And if they're all the vanilla plain things that normally they would say, then you need to either help educate them and bring them things and push them in that direction, which is a lot of work. They're professionals, they should do it on their own, but they don't have the time, or you've got to go find somebody who is proactive.
And so just bring like just to highlight that point, it is it is time it's now time on the business owner. And at the beginning you said business owners always need things yesterday. Things kind of can be urgent. So, putting my business on, I'm hearing you say, okay, there's got to be some kind of onus or responsibility that I take to make sure that I know what to look for. Um, but I think what I heard from your introduction is you kind of help with that process to be able to find or identify the CPAs who are best equipped to do this. Is that correct?
I can help people not only with the set of questions they can ask if they want to do it themselves, or we have CPAs as part of our group. I believe we have the brightest, most forward-thinking tax, legal, and financial people in the country. So I've been able to build a pretty good significant stable of really bright people. So yes, I can do that.
All right, beautiful. Um, Next question. What are some of the ways that business owners can use tax savings to create wealth?
Well, if you think about it, taxes are eroding our capital base. If I give you $1 today and it doubles every year for the next 20 years, so that's, 1, 2, 4, 8, 16, 32, et cetera. If you pay no tax on it in the 21st year, it's worth a little over 1,048,000. If we tax it every year at a 40% rate, it's worth a little under 14,000. So it's a significant number. So we have to look at tax accumulation in my view. You've got to find ways to reduce or eliminate taxes every year so you can take that surplus money by kicking the tax can down the road and use it to create wealth. So if I have a $500,000 worth of profit and I can certainly take it, I'm taxed on it. However, if I can find a way to reduce or eliminate some of that I wouldn't necessarily need to pay down debt or to do other things that I want to do, then every year that I'm not paying the state and the federal government a dollar, that's a dollar that's going into my pocket. And that's a way to really accumulate wealth.
Great. What percentage of business owners actually implement a business transition? And you kind of talked about this a little bit, but if you want to elaborate on it.
Yes, so the statistic is about 65 say that they will transition their business and that they will use those funds to be a significant part of their retirement. Only about 10% do. So when I had my financial planning firm, I transitioned dental practices for 10 years. And we did somewhere, 32, I believe. So we would actually sit down and we would map out a process. So as I said earlier, I know exactly what that sale looks like today, even though it might not happen for 6 months to a year. And that's because I want to understand what it's going to look like from a financial standpoint, from a tax standpoint. Also, there's other pieces of it are you need to be thinking about what you're going to do after you lose your purpose, right? If my purpose has been 30 some years or even 20 years, or I'm involved with a client right now where we're selling a $100 million business. He only had it 8 years. And so the idea, it's grown unbelievably rapidly. You've got to be able to say to yourself, what am I going to do when I'm not invested in that business every day? What's my purpose? What's life after owning the business? I mean, that's a really big piece. And I probably get 7 out of 10 people who tell me they have no idea. And that's because they've been so focused. Uh, you also have to, in my opinion, be looking at how you set the business up in such a way so that a year or two before you sell it, and you can prepare for this, you're not the main person in the business, right? So if the business is depending upon you, then once you sell it, then not only are you in a position where you still have to stay on with it, but you're also not necessarily maybe going to get the highest value for it. So it needs to be seamless. So I helped an automobile repair business at one time sell and a trucking company. And both of those sales were such that the business owner, people looked around after 2 years when the business was already sold saying, hey, where's Ted? Where's Mike? Well, that's because we set it up so that it was seamless so that when he wasn't there, that they didn't even know he wasn't there. And so the key is that you can't be, even though you're the founder and you're the one that put it together, the hardest thing that people have to do is they've got to figure out a way to separate themselves and it has more value and it's a much better transition.
Excellent. Thank you. I did have a question come in from Jim. Jim says, as a commercial real estate broker, can you provide one tip that I can mention to my customers, commercial real estate investors, to make myself a value add broker in regards to the disposition of their commercial property?
Well, I think that probably the number one is that in real estate, it's 1031 exchanges is what everybody wants to do, right? So you're going to exchange until you drop, right? And then somebody inherits the property at some point, and then you have a very low tax basis and you pass it on. There are such things called installment sales under 453A of the IRS code that have been around for years. And an installment sale is something that you can do with an appreciated property that allows you to defer the taxes, but you have use of the money And at some point they are due, but there's ways to mitigate those taxes in the future as well. So I would be suggesting they use an installment sale, and we do those. So if Jim wants to connect with me, he certainly can, and I'll help him out with that.
Awesome. And sorry for me, who is dense, can you just make a distinction between an installment sale and a 1031 exchange?
Well, a 1031 exchange is where you're basically going to find property that's like property that has a greater value than what the property is that you're selling. And then you don't pay the tax on the deferral is what you really do. And so
Yep.
you might be going from a piece of property that is not giving you income to one that is giving you income. And you've got to scramble around. You have windows of time. And it's a very, in my opinion, it's pretty tedious. But what happens if you don't find one? Then you're kind of in, up a creek without a paddle. Versus an installment sale is where you're not selling it to somebody over time. What you've done is you've exchanged the sale proceeds of the property for a note, which is a note that's on demand that where that note can generate income for you over time. And so as an example, you have a buyer, you have a seller, the seller is selling the property to someone. Now they have a capital gain. That capital gain is then taxed. And capital
Hmm.
gains, by the way, is voluntary. But when I say voluntary, I mean it's voluntary, but you have to do, if you don't want to pay it, you have to do something about it.
Yeah.
Right? So yes, you have to pay it if you take it. Well, an installment sale, there's much like in a 1031 exchange, a qualified intermediary is there who accepts the money instead of you, so you don't have collected receipt. And that's perfectly legal with the IRS because they know, number one, any income that comes out of it, in the future, you got to pay tax on. And secondly, is that it's going to come due at some time, that taxes. So you have to do something about it. So those are the difference. One is deferring the tax, and the other is basically just buying another piece of property or essentially exchanging another piece of property for it.
And who or what would be the qualified intermediary?
Well, so a qualified intermediary would be somebody who uh, has a business to be able to set up an LLC where that special purpose LLC would receive the funds, and then you aren't taxed on them because you didn't have collective receipt of them. I don't
Got it.
get too much into the weeds on it because it can get pretty crazy. And even the guys who we work with, custom structured settlements, they're CPAs and they've been doing it for 20 plus years. And even I get into those meetings and say I've learned something new. So, it's
Okay.
like talking to Albert Einstein of taxes.
All right. All right. And Jim had a couple of follow-up questions.
Sure.
One of them was on the, I guess, the 1031 exchange or the qualified intermediary option. Do you use those yourself?
Yeah, I do. Yes, I use the installment sales. So as I had said, we've also done what 42 of those in the last 7 years.
Okay.
Yeah.
And then Jim's other question was, how do you feel about Delaware statutory trusts and cost segregation?
Yeah, DSTs are great tools. Absolutely 100%. Yeah, they're excellent tools for what he's trying to do. Cost segs are dead. Yeah, they're gone. The when I say that, nobody's doing them anymore, primarily because of the fact that uh, the law really is changing. They changed it. They wanted to change it, so they basically stopped them. So the IRS doesn't know what they're going to do with the existing ones. I know that a lot of people are hoping the current administration, since our president's used a number of them, hopefully he would step in. But you don't want to be involved in cost segregation. So there is a thing called the fee simple, which is the subsection of the code, which maybe could be used. So those are opportunities that possibly could be used. But I would want to sit down in the specific situation with the CPAs we work with and whatever client Jim had or anyone and say, look, how would we do this? Another thing is opportunity zones for tax reduction, which is another thing that's being used out there. You got to find the right ones. They've come back now since the current administration has come in. They didn't look like they were going to flourish when President Biden was in office, but I think they are going to be much better. And then there are equipment leasing programs that you can do to
Mm.
offset taxes. And oil and gas also from a tax perspective is will reduce any income, whether it's capital gain and or it's ordinary income, because that law was enacted back in the 20s with Standard Oil and it's never changed.
With cost segregation specifically, I think I've seen a lot of buzz about the big, beautiful bill and helping to um, uh, increase the benefits of cost segregation. I think that's what I've kind of observed. Are you saying like even with the big, beautiful bill, cost segregation still just isn't the tool that it once was?
I'm sorry, let me back up. I was thinking about conservation easements, is what I was
Okay.
thinking about when
Okay.
I
All right.
cost seg and conservation easements. So yes, cost seg does work, and it is a significant way of being able to reduce or eliminate taxes. You just have to make sure that you look at whatever particular industry it's in. So, as an example, I'm involved in a client with a sale of a business, and they want to be able to take their proceeds and invest in RV parks. Well, how much of that is actually going to be able to be cost segged, right? So the best cost seg is usually some sort of a building like a dental office or something that has, yes, it has the building, but you're not taking the cost seg against the building, you're taking against the infrastructure.
Sure.
Idea is that yes, you want to be in a position where you can look at each of those specifically versus will say a dental practice be or an office building of some kind that has a lot of equipment in it is much has a much more benefit than something that say is an RV park. What do you really have? So you got to find the right people who can help you with that, and
Okay.
several of those as well we work with.
Perfect. And Jim, I see your other question there, and I'm gonna not answer it right now because I want to keep having us move along. But Jack actually had a comment, and I think it kind of is a nice segue to the next part of the discussion. Jack said, this is going back to thinking about uh, owners who are wanting to exit their businesses. He said,
Mhm.
"You were so right about wondering what I will do after I sell. I sold a few years ago and am still seeking my cause mission after doing tons of traveling, etc." So on that note, I want to ask about legacy planning. Most people think about legacy planning as just giving money to their children or to charities. Think about, Jack, someone who owns his own business and needs more than that. What are some options that that go beyond these like more traditional charity and children ideas?
Well, to kind of lead in and take Jack's question and how it relates to that. So I kind of think there aren't enough front porches anymore in America, right? We're not having conversations. And it's never too late, depending upon what situation you're in, to have a conversation and sit down. And there's plenty of people out there where you can have stimulating conversations and would ask questions of somebody like Jack to determine, what his purpose is. And age has got nothing to do with it, right? You might be 45, and I've got some clients where we helped who are sold in their late 30s and 40s. They still have a lot of years ahead. What are they going to do? Well, they still have children, so that changes it. Somebody who's older, that maybe the children are gone, are in a position where, what are they interested in? There's so many things that you can do, but it's a matter of sitting down and probing and asking and really opening up to what it is you want to do. And it's a big part of it. So, I mean, I understand where Jack's coming from. It's a matter of being able to focus on throwing it all out there and then whittling it down to the one thing that you want. Legacy plan is so interesting because oftentimes, the estate planning attorneys I run into when we do trust, they all want to revert back to, all right, you got three kids, we're going to give them a third and a third and a third, a third at 25, a third at 35, and a third at 45 because they probably weren't very smart at 18, like I wasn't when I inherited money. My father died when he was 58, I was 18. I ended up with a four-wheel drive truck and a speedboat and moved in with a girl who was 5 years older than me. And man, through college, I had a great time. When I graduated, I had no money and I had a degree, thank God. No speedboat, no truck, no nothing, right? So I blew through that money, and I just wasn't really smart about it. So we do have to be concerned about that potential thing happening to our children. But just to say we're going to do it at, certain ages means that now if you've amassed a significant estate, now what you've done is you've split that estate up into three pots, which who could potentially marry people, and even with prenuptial agreements and a variety of other things that you can put in there in separate trust. If divorces happen or deaths happen, then now what you've done is you've taken your estate and you've reduced it by a third. And the statistics are that a very small percentage of it ever makes it to the second generation. So I'm a big believer in let's look at how we can set up our wealth in such a way so it's generational wealth and that you're really helping people to do things rather than enabling them to have money, right? So I think that setting up legacy planning is more along that lines, and that's what we do with our family offices. We get the kids involved, the grandkids involved. If there are none of any of those, then are there nieces or nephews, right? But then it's also a matter of you'd like, three generations to have twice the wealth than being in a situation where it diminishes because we've divided it up amongst children and even charities, right? There's some great things in the donor advised area. If you look at Meta, and what he did, he and his wife didn't like that charities were taking most of the money and they were using it on, themselves, and then very little of it ever got to the bottom line. So they set up different kinds of charitable LLCs where they could direct where it's going to go. And, Zuckerberg made a total difference because he did that. So there's other ways to do it.
Talk to me a little bit about that, how you engage those clients who are looking for the family office structuring, and how that differs from, how you're talking to someone who's a business owner. Because I mean, I think there's probably very obvious examples, but if you've talked to someone who you've been supporting someone who's a business owner, now they're thinking about legacy planning and they're ready to kind of expand the conversation with you and bring in family members, for example. Tell me a little bit about how that process, goes. That sort of like nose to tail process when you're doing the family office conversation.
Well, I'm a big fan of, let's plan for, the worst and be really proactive in setting up our processes and procedures and then, we're planning in such a way so that we know what's going to pretty much happen ahead of time, right? And then we can course correct as we go along. So when I say planning the worst, that's probably the attorney in me, and that I've sat around too many of those that they're always looking from mitigating risk. So I say, all right, what's the possible things that can happen and how do we mitigate them? But look at options three, four, and five, not just one and two. Right. So from a family office perspective, is that what I find most of the time with business owners and individuals as well, is that usually there's one or two advisors that they're listening to most of the time. It's not a team. And I've seen too many times where the recommendation is a good recommendation for somebody coming from an advisor that maybe isn't their most trusted advisor, which is why when I interview somebody, one of the questions I ask is who's your most trusted advisor and why, is that they would listen to them and then not do something that was good for them because they had that trust in them. That's great that they have the trust, but I think you've got to have a team. If you go and Google on YouTube F1 pit stops as an example, right? You ever seen those?
Yeah, amazing.
They're 1.8 to 2 seconds in length, but there's 17 people doing something.
Yeah.
That's what you need to have. You need to have a good CPA. You need to have a good financial guy. You need to have a good attorney. You need to, and they all have to be talking to each other. And if I've heard it once, I've heard it, a million times. Nobody of my advisors are talking to each other. So I'm actually a facilitator for now 18 family offices. So what we do is we get together quarterly, we get together in person once a year. Anything that's going on in their life with any other advisor, I'm involved in. And the reason is that they're busy people, right? They want to go do the things they love, and then we get back together and say, okay, here's what we planned we wanted to do. The attorney's telling us to go this direction. I have enough experience over time to be able to say this is something we need to be looking at, and we all work together. and everybody knows what everybody else is doing, right? So, as an example, I got a call yesterday from a CPA who said two of my clients are getting the second installment of their earnout with their business. What are we doing with that? And that's what we need to be doing, proactive. Well, both of them have decided they want to look into certain things. So we're ahead of this. We're not behind the curve. We want to be in a place where we're ready for, are we going to do an opportunity zone? If we're going to take the money and pay down real estate, how are we going to mitigate the taxes? Or are we going to put it into the installment sale? So that's important. Everybody's got to kind of be talking to each other.
And I think, I mean, I don't know how all CPAs run their businesses, but it sounds like the success that I hear, a mark of success I hear from you telling that anecdote is that the CPA is reaching out to you to even have that conversation to begin with, and start, like, they know to talk to you, and they know that you'll be able to direct, guide, strategize with them, and then that can be presented to the clients.
Correct, because the client and I have sat down and gone through every aspect of what they want to do. So I'm familiar. I've developed what I call a Q28, which is a document that essentially asks really detailed questions that can really get into the visceral feelings of clients so that I can understand, what their desires are. And if they're on a trip to the Amalfi Coast or they're going to Charleston for their anniversary and their birthday, and something comes up, then I can be the go-between. And that way they're not in a place where, again, they say we want to save you time. We can't save time. You can only spend time, but you can spend less time. So the idea is that that's what we want. We want the ability to do that.
So we kind of talked about, I would call that like a success story. The fact, I mean, it's successful because the conversation, the manner of the conversation is happening in the way it should be. Do you have any sort of like kind of horror stories of total disorganization or lack of alignment?
Wow. I mean, if I look back over, 37 years, I'm thinking about things that I think probably the most horror of all stories would be the ones where we had conversations about tax mitigation on sales of appreciated assets. And then it came down to uh, one one kind of thing happened in it where a spouse, didn't like somebody, or a somebody didn't understand the process and how it worked, and those kinds of things. And then, they ended up paying significantly more tax because there's something that they just can't get over. And that's because oftentimes people just can't wrap their heads around it. But
Hmm.
here's a funny statistic. When I look back at all of the different deals that we've done from a sales standpoint, if the tax was more than 1 million, we didn't really have any trouble saying, look, let's look at tax mitigation. If it was under 1 million, 50% of the time people didn't do it. And I don't know why that million mark, maybe, I'm going to be a millionaire or something about it. But I'm sure that some psychiatrist or psychologist out there could kind of have a thesis on that. But it's really strange. It's a strange number.
It's like you have to have X number of commas for it to make it a problem or make people pay attention or something.
Yeah, it's just one of those things. But again, I mean, you don't have to pay tax, but you have to do something about not paying it if we're
Right.
talking about tax. You don't have to sell your business, but if you want it to have it the highest value and be able to mitigate the tax and to be able to have the, what am I going to do afterwards? You have to sit down and do something about it. And even if it's done, you still can do things. It's just a matter of, okay, what have I learned today? And thank God, because I'm learning every day, which is what's so much fun about business.
Awesome. Um, so I appreciate you answering that last bit. We did have, oh, here's another question. What is the transition plan, or who, parentheses, or who will run the business for Neal's company or services?
Well, that's a really good question. I get that a lot. So over the years, I have tried to find younger individuals, and I still am in a process where I'm trying to do that. My actual staff could run about 95% of my business if something happened to me or if I transitioned out. And I've done that purposely because I hired who I think are the best people who are task oriented, because I'm very task oriented. and they basically take care of things for the family offices without me being involved. It's seamless, which is really nice. Now, when we're talking about getting together with planning, or the client wants to talk to me about my experience, that's a different story. Um, I actually have also set it up so that if for some reason I would get hit by the purple bus tomorrow, is that I have trust companies, attorneys, I have trusts that have been set up, third-party administrators like Camoplan, and other people where another person could take over seamlessly. I mean, it's what I've done is I've made that my transition plan. Will I'm looking at where I'm going to be later in my life and what I want to do as far as transitioning out, and I'm still looking for somebody who, if they wanted to come in and learn it, but it takes a really different personality. You have to be really service oriented, right? You have to pay attention to everything. You have to ask questions. You have to really understand your clients in such a way that most people don't. And that's really the key in having a successful business. But my transition plan, I'm still in search of, but I've got it set up so it doesn't need me to run, which is the important thing, except for my experience.
Beautiful. And that same person asked, do you have minimums of clients you work with? My business grosses $300,000 a year. Does this qualify?
Well, I do have minimums, and but what I will do, what I always do to everybody is I say, call me and let's have a conversation. If I can't help you with what we're doing, then I'll make sure I find somebody for you, because people when people ask for help, I like to help them. I was put on this earth to have meaningful conversations with people and be significant in their life. That's my purpose in life.
And actually, what's the best way to reach you? I'm going to
So
chat everyone.
email or phone's fine. I answer my own phone,
All
so
right.
it doesn't go to anybody else. So my cell is 858-344-5110, and email is Neal, Neal, at GETEQUITI.com. And you can go to the getequity.com email or webpage. It's my old financial planning page, but it's still, you can go there and all the information's there. We're in the process of putting together a new one with the family office at this point in time.
Beautiful. And I'm not sure. Okay, thank you very much for providing that. And then I'm not sure if Jim is still on, but he did have a question kind of going back to the commercial real estate investor
Uh-huh.
um, conversation, which, oh, there he is. He says he's still on. Okay. He says, how would you engage a client in Pennsylvania? Are you based in Pennsylvania? Sweet.
Well, we do business. I do business, and the firm does business all around the country. As a matter of fact, I sold a business for somebody the business was in San Francisco, and they now live in Lake Como. And I actually visited them this year to talk about their after planning and work with their advisor in New York. So yes, I can help in any state because everything we do is both federal, and even though I live in Arizona full time and spend my summers in California, yeah, I can help a client in any place.
Really had to twist your arm for that Lake Como trip, huh?
Yes, it did. Well, I love Italy, and it's one of the only spots that and the Amalfi Coast I haven't been. So he said, "Why don't you come over?" And I was actually in Europe anyway, so it just worked out.
Perfect. And so Jack asked if we could post your contact details. So Jack, I put them in the chat. You should see it. It says it has Neal's phone number and his email address. But we'll make sure that we share the contact information when we send out the recording to everyone too, so you have that there. So we're at 12:45. Um, and I think that's going to wrap us up for today. Any kind of closing thoughts, Neal, that you'd like to share?
Well, I think the only thing that a couple of things that I can think of as far as business owners concerned, and anybody for that matter, is that if you can sit down with somebody and you can develop the right process, procedure, and plan and structure ahead of time, it just works so much better because you have the opportunity to be able to make changes and course correct when you need to, and it sets yourself up for success a lot more. So, and ask questions. Bill Maher, and not the very famous Bill Maher. There's a Bill Maher that I know who wrote a book called Asking the Right Questions. And when I went to get a loan for one of my houses, it's a fairly lengthy story, but I'll just summarize it. I was asking all the right questions because I'd read the book. So the more questions you ask, the more right questions you ask, the more you can arm yourself with the knowledge to be able to understand the options, and not just one or two, but three, four, and five. Allows you to be able to, have the life that you want, and enjoy it much more because you're financially stable, and you can increase your wealth and do the things you want to do.
Aisha asked, how can we get a list of the questions to ask our attorneys and CPAs to ensure we're getting the best tax savings annually?
Have her send me an email.
Perfect. All right. Awesome. Appreciate it. And actually, I did have one more question. And when people are talking about asset management specifically, if I sit on or if I listen to those panels, um, the question of timing always kind of comes up, or when should I start thinking about this? And asset, um, asset protection specialists will always say, hey, it's better to organize things when they're less complicated than waiting until you amass all these assets and then have to figure it out. Can you talk a little bit about like timing of when people should think about this as business owners, or having the family office conversation?
Are you asking in terms of when to start? You
When
should.
to start? Yeah, literally that.
So I always think the younger you are, the better it is, right? Because time is the thing that can help you out the most. I mean, if you look at I traded 100 million in and out of the market for 20 years, and I still trade my own account. The point is that the earlier you start, the better, because time will really help you, right? If you start in your 20s, by the time you're, in your 40s, that's better than if you start in your 40s and you want to retire at 60, because time makes the difference, right? It compounds. The family office situation, typically family offices are what, one half of 1% of this country is worth 10 million. So it's pretty rare air. So the idea is that if you having a family office in the way that the family offices are set up, if you're worth 50 million or 100 million, and oddly enough, up to 150 million are the most underserved, which is crazy, which is my market.
Yep.
And I don't want the 250 to 400 million because you're just a number. To me, I love to be more hands-on. So I think the sooner that you can look at how it works, you can even use components of it, right? Because it takes certain components that all at some point come together, so that way you've got the whole, so to speak. That'd be the best way for me to put it. So
Hmm.
there's nothing wrong
Okay.
with saying, okay, maybe the first component is, how do I structure my business so that over time I'm around, but people don't see me as the figurehead. You might find a certified exit planner for that, and I know a number of those guys. So the point is that might be the first step, right? The second step might be, okay, I want to start creating wealth, go find a good CPA, and the CPA can help me save, let's say my goal is 25,000 a year. So I'm compounding that, putting it away somewhere, it's growing, and I'm in a position where that creates wealth. The next part might be, all right, my kids are getting older, I want them to be involved in the business. How do we structure, the things we want with them to be involved? And certainly along the way, everybody should be starting with asset protection and estate planning, because we live in the most litigious society in the world. And I read an article here 20 years ago about, they asked 100 people how they were going to be millionaires, and earning it was not in the top five. Okay, the top three were litigation, lawsuit, lottery, and inheritance. So we live in a pretty crazy world. So asset protection needs to be, if you haven't done asset protection as an individual or a business owner, then you need to do it. And then the estate planning, we figure we're going to live forever, but unfortunately people die. I had a client die at 34 in a car accident, and I've had clients die at 94. So you don't know when you're going to go. I mean, none of us will get out alive. We just got to find the loopholes along the way.
Perfect. Well, that's a great way to close on. I will say, to go to my timing question, I like how you dug down and said it's not just, I mean, you can, earlier is always better. That's easy, but to like kind of pick it out in parts and start and go in stages, that's really, really fantastic. So thanks very much, Neil. I really appreciate it. And thanks everyone for not only participating but really participating in a nice dialogue with this one. Um, that's going to wrap us up for today. We'll get the recording out to you along with Neal's contact information, probably at the latest by Monday, but we'll try to get it out earlier than that. And then you also have Neal's contact information in the chat as well. So feel free to reach out to him. I can attest that I talked to him beforehand, and he's a nice guy. So with that, we'll see you on the next one. Thanks a lot, Neal. Really, really appreciate it.
My pleasure. You have a great day.
You too. Bye bye.
Yeah.